Hey guys, welcome to the Smart Venture Podcast. In each episode, we're going to have conversations with some of the top investors, superstar founders, as well as well-known tech company executives in Silicon Valley. We'll have a coffee chat with them to learn their way of thinking and actionable tips on how they build or invest in a successful company. Before we start our show today, I want to make sure the listener, aka you, understand that everything a person say on the podcast only reflects hers or his own opinion, not the show or the company they work at. Our guest today is a partner at Floodgate. She sits on board of portfolio companies, make investments, and help them build strategic corporate relationships and financings. Floodgate's portfolio includes Twitter, Lyft, Twitch, and many others. Prior to Venture, she was a VP of Goldman Sachs, where she directly worked with the CEO of top companies like Disney, SanDisk, and Yahoo. Her name is Choi. In the fall 2020, I was really lucky to be a cohort member of Floodgate's Building Breakthrough program. And that's where I met Iris. Hi, Iris. Thank you so much for coming onto the show, even after we chatted for 20 minutes. So.
Yeah, exactly.
You are obviously super impressive. You worked at Goldman Sachs as a VP before Floodgate. I would love to let our audience get to know you a little bit better on a personal level. Tell us more about how you grew up and how you got to where you are today.
Yeah. It's funny. I know that you had previewed with me that you wanted to have a better understanding of my formative years and how that's impacted who I became. And when I think about it, so I think I'd mentioned to you before, I was born in the States, but then I actually lived in Korea from when I was 1 until I was 5. And so when we moved back to the States, I didn't speak any English. And I grew up in a small town, going to the public schools of Pacific Grove, California, and that is not that racially diverse. So much so that I may have been the first student that needed English as a second language classes. And it was so challenging that the school actually called my parents and said, she doesn't speak English. We're not quite sure if she has learning disabilities or she's mentally challenged. Mm-hmm. And my mom is a physician. So the good news is, my mom would have been able to spot the signs if that were the case. And of course, their response was, no, she's just never spoken or heard English because we just moved here from Korea and we need to get her special teachers. And it was hard, right? Because being a minority in a community where you feel like you're being marginalized because people don't know other people like you is a really challenging experience. And when I look back at that, I think that what my childhood taught me was that I needed to be resilient and I needed to be willing to take control over situations and figure out a way to not only survive, but really thrive. I think it also taught me a broader lesson, which is everyone lives their own experiences. And so I can't speak to other people's experiences, but I do know what it's like to be marginalized and have people assume things about you because you don't fit the mold of what they're looking for. And, I grew up going to the public school systems in Pacific Grove and one of the few people from my high school that left the state of California. And I'm still the same person that they thought was mentally challenged in kindergarten when I showed up from Korea. And so I'm just a big believer in giving people a chance and not assuming that because they don't fit the mold of what you expect, that they are somehow lesser than or don't deserve that opportunity. And so it's a lot of that spirit that led me to start the Building Breakthroughs class for Floodgate, which is obviously how you and I met, and why I wanted that pilot class to be focused on underrepresented founders, to be able to give them an inside look at what VCs are looking for in the companies that they back.
Yeah, totally. I can totally relate to that since I was an international student too. At school, you had to learn the language and the actual lessons at the same time. How did you turn the negative energy into positive? You are obviously super competitive. Did your parents force you to study, or what was the mentality you had back then?
Yeah, it's a very valid question. Thinking back now, at the time, I'm sure I didn't appreciate it like most children. But I think what my parents really tried to instill in me is this concept that you deserve to be here just like anyone else, right? And if there's an opportunity, there's nothing that should lead you to count yourself out. And so even though it probably took me until maybe second grade to be really proficient in English, both in terms of speaking without an accent and reading, By the time I was in fifth grade, my parents were like, you're going to run for student government and we'll help you, but you should do this, right? And my parents are big believers in not being that involved, to be frank, in schools, right? They want me to study hard and they are, on top of me about doing my homework, but they're not exactly the parents that are going to show up and volunteer at school, especially because they were both working full time. And so there was that self-starter mentality that they instilled in me combined with really high expectations. And so what I would say about, whether or not I'm competitive is I'm very competitive with myself, right? I oftentimes I worry into being too hard on myself. I'm much harder on myself than I am on anyone else. And so it really was this expectation that I grew up with that if there's an opportunity, I should always make the most of all of my opportunities because those are luxuries. There's plenty of people that didn't get the opportunities that I did, but also that I should never count myself out and I should try to pursue all the opportunities that I can.
Now you work in VC. Back in time, you worked in finance. Were you always really good at math when you were younger? What made you decided to go into it?
Yeah. So I don't know that I went into college thinking that I would do finance because, to be honest, again, growing up in Pacific, California, there are no investment banks. And so I wouldn't have had exposure into the concept of Wall Street that I got much more exposure to in college. Growing up, I did kind of lean more into math, partly because even in elementary school, I wasn't that strong in English. And so I had to play to my strengths. And then I just kind of kept accelerating from there.
Wow, that's really interesting. Right now, you're a great communicator. Maybe that has nothing to do with English class in elementary school. Who is on your personal board of advisors? Who do you consult with on your career decisions?
Yeah. And so I'll speak about it more from a career perspective, which is, I would often read stories about people who said, oh my gosh, I had this incredible mentor and they championed me. And that is how I got to where I am today. And I would read those stories and be like, yes, who is my person going to be? Right. And I think that's incredible. And I'm sure those stories are amazing. And I wish that for everyone. But I think in reality, those are the outliers. That's not usually what happens where the founder of a firm, plucks one person and says, this is going to be my legacy. And so what I've realized I do instead is think about having a council of advisors where, some of them are mentors that I had at Goldman who they themselves have left into other careers. And so could guide me through those transitions. And what I've also realized more recently is that it doesn't have to be people that are more senior than me or older than me or have more tenure in the industry that I'm in. An example that I would give is I learn a lot from the chiefs of staff that I work with at Floodgate, right? You obviously know Jay, but Mitchell Kogan is one that's now a product manager at Facebook, and he has design sensibilities that I could only hope for. And so when I was working with him, we would do a lot of analyses around later stage companies, and I would just dump all this data on him, and then he would somehow translate it into a way that was beautiful on the slide. So someone who didn't spend 10 years in banking could understand it as well. And so I make the joke often, but it's true that anyone who spends more than 15 minutes talking to me doesn't realize it, but they become one of my life coaches where I'm always looking to learn, but not just about finance, about, how to be the best version of myself. And I feel like I'm often looking to others to try to understand best practices or also just how to change my outlook to be someone who's more growth oriented.
Yeah, totally. How do you shape your personal network to keep yourself being smart? Do you try to surround yourself with finance people? What type of peer do you intentionally keep in your network?
Well, so again, I take the approach where I want to know that I'm growing in all aspects of my life. And my career is obviously a big and important one of it. But to be frank, I'm more likely to be caught reading a self-help book than I am like a book published by Harvard Business Review.
No way.
And so what that means is that when I think about my personal network, it can be based on subject matter. So it's other women that I know that are VCs, but a lot of times it's people that are in a similar stage of life, right? So I'm a mom, I have 2 kids, trying to navigate the waters of being a good role model for them while also, kind of supercharging my career, being really involved with their schools. So I'm constantly looking for ways to grow in all aspects of my life. And the career is just one aspect of it.
Yeah, that's so humble. In terms of technical skills beside English, what is a skill you think everyone should have or you're constantly trying to improve on?
Yeah. So I know you had asked me before about the transition when I went from college to banking. I went to a liberal arts school. And so the joke is always, you don't actually learn anything that you can apply to your job. You just learn how to learn. And so that transition, to be frank, was a rough one, right? We didn't even have accounting classes at my college. And so that first year in banking, to be frank, was just a grind. And I think that that's true of most people, even if they went to Wharton and had a business undergraduate degree, because there's a lot of just expectations and the bar is high for what it means to be a professional investment banking. And so again, that's where I kind of lean on, okay, is this really harder than trying to learn English when people think you have a mental disability? Probably not. And, on that point, I think that's the other aspect that my parents really instilled in me at an early age is, yes, things in life are hard, but that's not a reason why you don't do them, right? I've had people ask me a lot about what's it like to be a woman in venture or a woman in investment banking when it's so male dominated. My mom was a physician in the U.S. Army, right? As a Korean immigrant, naturalized U.S. citizen. My sister went to West Point. I'm not exactly from a family that shies away from challenging environments. And you have to sometimes actually lean into that discomfort and you see it as an opportunity to grow and really just grind it out. And so in terms of, skills, to be frank, I know people think it's fun to hate on investment bankers. I think it's an incredible platform and a way that at a very young age, you're doing a lot of reps and seeing a ton of different challenging deals and learning the pattern recognition to be able to give advice as you become more senior. And from day one, especially if you're at a bulge bracket firm, you're only interacting with the C-level executives of these, Fortune 500 companies. And I really don't know if you're interested in finance, a similar experience other than going into management consulting.
Yeah, the plug is coming a little bit sooner. You air these mini Twitter series every Monday about the market. For people who didn't major in finance, what are some ways that we could understand finance and the market better?
Yeah. So this is where I'll insert my plug to follow me then on Mondays as we talk about what's happening. Yeah, exactly. To talk about the markets and especially their relevance for the startup ecosystem. But I think that the other plug I would actually give is for the equity podcast. Alex Wilhelm and his team at TechCrunch do an excellent job again about talking about recent news from both the macro and public markets, but primarily they focus on obviously private venture-backed companies as well. But pick up the Wall Street Journal and just start reading the market section and try to better understand not only what's happening in terms of the news, but what it means about future trajectory. And I think that's what oftentimes people who didn't study finance in school or through their careers don't necessarily appreciate is everything in the public markets is about expectations. And so anything that you see in terms of guidance, yes, it's funny because companies announce how they performed and you'll see changes in their stock price, but it's really about future expectations that people are baking into the value of any company that they are either buying or selling. And so trying to better understand what the outlook is for the economy is really what's critical when you're thinking about the markets.
Totally. Is there any crash course in venture financing for founders? Say, if I want to pitch you in 3 months and I don't have any finance background knowledge, how do I quickly adopt the basic finance forecasting skills to present to you during my pitch professionally?
Yeah. So the good news is that if you are pitching Floodgate or me at the seed stage, it is less about, can you show me your financial projections? Because to be frank, we're early enough that you may or may not have a product that you've launched, right? So it is important to us that you've thought about what will your business model ultimately be? Because, and you've heard me talk about this in our class, this concept of the minimum viable company, where it's not just about saying, I have this really cool product or this feature or people are going to love the product. It's like, okay, how are you actually going to monetize that? And so, I would encourage you to focus more on thinking through your product and the business model, and what is so compelling about the value proposition of your product that people will want to pay for it in some way. And when I say pay, it's not always monetary, right? Are they going to pay for it in terms of there's a lot of friction in the onboarding process, but they're going to stick with it, right? Are they going to give you a dedicated amount of time, engagement every day? And thinking through the bigger picture versus at the right time. Yes, you will have to build a financial model, and that's important. But, hopefully at that point, you have seed investors who can help you with that.
Speaking of investors, can you share with us more about the transition between Goldman Sachs to Floodgate? You work at a tech company in between. What is the transition like from Wall Street to venture investing?
Yeah. So when I left Goldman, I wasn't really sure what I wanted to do. But one of the ideas was that I do come from a family that does a lot of public service. And so, I talked about both my sister and my mom served in the U.S. Army. My brother has been general counsel for over 10 years at a microfinance organization called Kiva. And so this concept of having almost like a second career where you're more oriented towards somehow serving either your country or giving back in some ways is something my family really believes in. And so in my mind, I think I had always thought the transition after Goldman would be I go and work in a nonprofit. And I really did want to work at a mission-oriented company. And so I went to a group called Source, which is this amazing nonprofit that, at least at the time, was focused on creating digital work opportunities for talented women and refugees in places like Kenya and Uganda, where they're English proficient, usually college educated, but there's not a lot of local work opportunities for them. And it was a really interesting operating experience because even though it's a nonprofit, and so really looking for grants, in terms of the work, they were competing against, Mechanical Turk, Crowdflower, and a lot of other venture-backed startups. And so the pace of building and shipping product was fairly intense. And so I'm glad that I had that opportunity to actually get more operating experience. I was there for about a year as the head of business operations, which was a catch-all title for anything and everything. I built their business model. I do a lot of their hiring, reviewing of legal contracts. And then I switched over to Floodgate, where I had first come in as a partner that was more focused on everything outside of investing. And so building out kind of a network of corporate contacts, taking on board seats, helping our companies think through exit opportunities. And then over the last couple of years, we have devised a new strategy where we run our reserves as if they were an opportunity fund and proactively seek out opportunities to potentially increase our ownership over time. So that's when more where I've been narrowly focused.
When you first came into the VC fund from a finance background, what are some first moves you've made at the firm? What kind of programs or partnerships do you think a VC firm should have?
Yeah, and there's a lot of varieties of what venture firms offer these days, right? And so I look at, for example, Andreessen Horowitz is who everyone points to as someone who's done an incredible job at building out a platform. And so yes, there's obviously an investing team. That's what they're primarily known for, but they have marketing gurus on staff. They have people who will recruit your engineers for you. And then they have an executive briefing center, which is almost like a biz dev shop with the Fortune 500 companies coming and hearing you pitch to them. I think that funds have to be fairly explicit as to where they are going to fall on that spectrum. And to be frank, with Floodgate, we're a smaller fund and we're a fairly small team. I mean, you've met all of us, right? There's only 4 partners. And so we knew that we had to play to our strengths, which is if you get a check from Floodgate, the benefit is that you have access to the entire team. But we're not going to necessarily have all the bells and whistles of a later stage firm, partly because we don't think that you would necessarily get the full advantage of that when you're at the seed stage, right? By all means, when you're at Series A or B, get one of those bigger platform investors to invest in you so you get the benefit of having that network. But at seed stage, what we think matters is that we know the 0 to 1 stage incredibly well because that's the only stage that we play in. And so we will be the people who take that leap of faith before anyone else and hold you accountable for iterating quickly, being capital efficient and building something that's truly worthy of you then being able to raise a Series A.
If I'm a startup trying to build relationships with the corp dev team, how do I go about it? The initial conversation, maybe not that hard, but how do I create an ongoing relationship with them moving forward?
Yeah, and this is where it's in some sense easier to develop that relationship if you're a VC, because I probably have a portfolio of companies that might be relevant to a company like Google versus if you're just representing yourself. And, people in the startup ecosystem are of two minds about corp dev relationships, right? Paul Graham kind of wrote a very well-known blog post basically saying don't ever engage with them. But I'm of a different mindset, probably because I grew up in investment banking, working with corp dev leaders. When corp dev is done well at a company, it is not about, no worries, former investment bankers coming in and executing on your deals. It's about people who are thinking very strategically and partnering with the GMs to better understand what is the trajectory of a business and where can they have organic versus inorganic growth. They can have a very symbiotic relationship with VCs where I like to meet with them and be able to say, here's what we're seeing in terms of, new and cutting edge technology that's probably going to be relevant for you. How much of this is already on your 5-year roadmap and is being built internally versus might there be opportunities for you to partner with one of our companies? And when I say partner, I really do mean that, right? I'm not coding it to mean like, do you want to acquire one of our companies? As you know, when Floodgate invests, it is always with the hope and expectation that the company can be standalone worth more than $1 billion and go public. We're not looking to make quick exits via M&A. And so what I would say is that if you are a startup founder trying to develop those relationships, my hope for you is the reason why you want to develop the relationships is because, again, corp dev done well serves as your Sherpa within an organization, right? And so that's where we've had the benefit of Floodgate being able to say, oh, if you're having an issue with like an app store somewhere, like maybe we can find you the right person to help us better understand what we did wrong and how we can address the concern, not because we're saying, hey, corp dev, can you visit this company and see if you'd want to acquire it?
Yeah, you mentioned that VCs can build relationships better because they talk to a lot of companies. So it's meaningful for corp dev team to build relationships so they can have access to a bunch of companies. As a startup founder, how should I do something similar to execute on this advice?
Yeah, well, so what I will say is that a lot of the larger organizations, so for example, Google and Amazon in particular, actually now have programs that are intended to make them more easily accessible and easier to navigate for startup founders. And so that may be probably the easiest entry point versus going the corp dev route.
Interesting. Can you elaborate on that?
Well, so the ones that I'm thinking of usually come with free credits. So for Google Cloud or AWS. And then if you need help getting introductions to certain different business lines within, for example, Google. I mean, I can only imagine that's incredibly challenging to try to figure out the right person to speak with, and they can be your Sherpa within Google to try to help you get in touch with the right people.
In terms of getting into VC, you recently did a talk at Wharton. You were competing with execs from big tech companies. How do you find your strengths and coming up with strategies to demonstrate your strong suits to compete with someone who is great in other areas?
Yeah, no, and I think that this is a really important lesson that I learned, which is when I was interviewing at Floodgate, I'd already spent, more than 10 years in investment banking. And I'd also gone to business school and also spent like a year in early stage venture before business school. And so I was just personally at a stage in my life where I was no longer willing to fake it until I make it, right? Like I'm always looking for opportunities to grow, but I was very clear with Floodgate, if you're looking for a partner, because I've been an investment banker, for example, that you think I can be dropped in as a CFO for your companies, that's not me, right? And that's not me because, I didn't grow up in accounting, nor do I really, to be frank, have an interest in playing that role. And so what it meant though, is that I needed to convince Floodgate that they were looking for me, even if they didn't know it. And so for me, what that meant is I pitched them on this idea of venture capitalists love deploying capital, right? That's kind of where all the glory is I wrote a first check into company X, Y, and Z. What I suspect is happening, though, is that a lot of VCs write that check and then they figure, there's just a lot of luck in it. And now it's up to the company to be able to execute against expectations. And then there'll be an IPO someday versus, I had spent, again, my almost entire career up until that point coaching CEOs through sell-side processes or IPOs and working with them for example, 2 years in advance of an IPO to get them a public company CFO and then get an audit chair and make sure they were having well audited financials and helping them do M&A in advance of that so they could get at a scale where they could actually go public. And so I'm much more of a believer that exits are intentional, right? Even these concepts of, oh my God, did you see overnight this company was a success or became acquired? Those conversations had probably been going on for a minimum of 2 years. And so my pitch to Mike and Ann at the time was, you guys are best in class at writing the checks, but I think you're now at a stage of maturity in the fund where we need to start thinking about harvesting exits. And whether we like it or not, right? It's in my DNA that every opportunity I see, even at the first pitch, I'm thinking through, is there an exit path for this company? And if there's not, then I wish them well, but they should probably bootstrap instead of taking on venture funding. And if there is an exit path, what does that mean? And how do we make sure that they're correctly on that path? In practice, what that means now is I'm very clear when I start working with a company, you need to have a fundraising roadmap in the same way that you have a product roadmap, right? Meaning that if you know you're going to become $1 billion company, how much capital does that require? And based on how much capital, that will influence which kind of investors you're going after and how much you raise in each round and what the milestones are that are going to justify the round size and the valuation that you're looking for. And it's a lot like the public markets where you should both be getting credit for what you've achieved thus far, but it's really the trajectory of what any investor that's coming in now is going to be able to ride the upside in. That should get people excited about investing.
Yeah, that's such a great pitch. When you're looking at a startup, how do you figure out the way they exit? Can you give us an example of how you analyze an enterprise tech company and a consumer one?
Yeah. And so, we've talked about it in our class that historically, a lot of times people would think about, for example, with a consumer app, like if I build it, they will come, right? All I care about is audience. And I could put you on the spot and see if you learned from the class.
Oh, gosh.
But, the danger in that is historically, those models really just defaulted to advertising, right? Monetizing the audience that you had. And that's obviously much harder to do these days because the likelihood that you can monetize an audience better than Instagram, Facebook, Snap, Twitter, right? It's just going to be challenging, especially as a startup. And so that's why we really think it's important that even in the early days, yes, you should be focused on product, but you need to have some sense for what the business model is going to look like. And so when I talk about, is there a path to an exit for a company? It's talking about a couple things. One is like, can this company actually scale? And here's where oftentimes we will see a founder that sometimes almost seems like he or she is building technology for technology's sake, where it's really cool. I'm sure it's incredibly challenging, but what is the actual business application, right? Like how is a business going to be convinced that they need this and they should put dollars behind it versus it's a nice to have. And so is there enough that this company isn't just going to be a feature or one product, but can it actually scale and grow and then have multiple products that, again, it's going to be worth more than $1 billion someday? Because it's rare that a company goes public with only one product and it's the same product that they started off with at the very beginning. And so most companies' expectation is that they become, to a certain extent, a platform where there's multiple products that are being offered. And then on the consumer side, I think it's around, similarly, will there be either enough scale in terms of audience or enough ancillary products that get added on that the level of engagement and then the ability to potential to monetize because of that engagement will continue to grow over time, right? Will this team be able to continue to innovate and come up with either enhancements to their existing product or more products that will keep drawing the users back in versus there have been a lot of businesses that it's kind of like the one-hit wonder when it comes to music or songs that were exciting for a period of time versus will they continue to advance their product so people feel the need to keep coming back and it becomes a daily use case ideally.
You took many pitches and you've seen so many portfolio companies. Can you give give us an example of two companies in the same sector with similar innovations, but one is scalable, the other one is not?
Yeah. Well, so I'm going to speak about it more generally to start, which is a lot of times, and this is not a bad thing, this is actually a good thing. Founders come with us because they are addressing a problem that is a visceral need that they feel. And so they'll say like, oh my gosh, this is like such a pain point and it needs to be addressed. But oftentimes it's a pain point for just that person, or it can be a niche product, which is not necessarily a bad thing. But if it's a niche product, it becomes the question of how much are people willing to pay for it. And when we say niche, is it niche for an audience of 100, in which case you need them each to pay, $1 million? Or is it niche, meaning that, it's only kind of intended for a certain subsegment of the population? And in full disclosure, and with a huge dose of humility, sometimes we get that wrong. So for example, with Peloton, I don't believe they pitched us. If they had, it may have predated me. But I would have seen Peloton and thought to myself, oh my gosh, that's meant for like maybe the 1% of the 1%, right? It's a pretty big upfront cost, plus like, I want to say like $30 to $40 of streaming fees monthly. And I was wrong, right? It ends up that the places where it's actually most popular are not the coastal cities, but the areas that are more kind of Midwest and everywhere else where you don't have, or in advance of COVID, there were no Soul Cycles, right? That you didn't have a, 15 person bike studio that people would spend $35 per class for. And so it ended up having much broader appeal than I was assuming it would when I first heard about it. And now I have a Peloton, right? And so it gives you a sense of how wrong I could be, that in my mind, I was thinking, who would actually do that? And it ends up me, I would do that.
Yeah, I feel you. That's such a good example. Now we talk about the investing philosophy and how to build corp dev relationships. Curious, what's a day-to-day like for you at Floodgate?
Yeah, so my day-to-day, oftentimes on any given day, I'll have at least one board meeting, right? And so we coach, especially newer members of our team, that when you think about your evolution as an investor, there's a lot of emphasis that's placed, especially I feel like the urban legend around like associates is that like you got to bring in good deals, right? And obviously that's important. So the concept of, do you know about deals that are happening? Can you actually decide when it's a good deal? And then can you win with a term sheet, right? Because obviously term sheets are given. It doesn't mean that you're necessarily going to be the person that gets the lead or the allocation. But then once you do the deal, then it's the hard work of actually being a good board member, right? Are you going to be able to help this company stay on track, accelerate, fundraise, all of that. And then ultimately, hopefully you can also help the company exit at some point. And so a lot of my day-to-day responsibility is around the second half of that. I still source deals, but because of the way we've constructed our roles and responsibilities, even if I source a deal, I'll hand it over. I've handed one over to Arjun. I've handed one over to Anne. I don't think I've handed one over to Mike yet. And they'll write the first check in to allow me to a certain extent to have a degree of neutrality for when they do their next round of funding. And then every check after that first one, in theory, comes from my checkbook. And so that's where I spend a lot of my time is I get to know the founders, if not in the pitch process. And as soon as we actually write that first check in, and I'm working with them, to my earlier comment around fundraising roadmap, when they think that they're ready to fundraise, I'm kind of their first pitch, right? And helping them set up their data room, build their financial model, prepping them for what the diligence process is going to look like, making intros, right? And hopefully I'm spending my time in the background talking to the Series A and B investors to better understand what are the sectors they're looking at, what are the metrics that they're honed in on that would make them excited about an opportunity, facilitating those types of introductions. And then also thinking from a portfolio management perspective, evaluating, where do I want to place my bets in terms of what is the maximum return that I can get for Floodgate based on all the follow-on investing that we do.
About following rounds, what are some patterns you see in making the next round of investments? Is it the most hyped portfolio company gets the most amount of funding? Even there are more numbers you can use as data point, but early stage company pivot a lot. What are some metrics you use to evaluate and predict the outcome?
Yeah, no, it's definitely not a science. It's an art, and it's one that we're holding ourselves accountable to keep evolving. And so, in 2 years, I may have a very different point of view than I do today. But right now, I think the part that's challenging is that it's not just a one-off check. It's one check that is part of a portfolio strategy. And what I mean by that is, to your question about, do we naturally follow on into the most hyped companies? Not necessarily, because if we did our jobs well in the first check that we wrote, then ideally we got our target ownership, which most times is, greater than 10%, hopefully, ideally like 15% or above. And if the company goes to, let's say, 100 million very quickly, then we actually don't suffer that much dilution by not participating. And I have to think about the opportunity cost of any money I put into that company. What is the likelihood that I will get a higher return versus another company that's about to raise their Series A that may be raising at, 50 million, and maybe they have just as much potential, but they're in a sector that's not getting as much hype as the first company. And so there's those trade-offs that we're constantly balancing. There's also the life cycle of the fund, meaning that companies that we invest in early in the life cycle are obviously going to come back up for follow-on investing before we've even fully deployed first checks in the first one. So trying to have a sense for, do I have enough conviction about the companies I've already seen that I'm willing to pour my money in before I have an opportunity to see other companies that are going to come back up for funding.
In terms of founder characteristics, do you see any patterns on the successful ones? For example, big tech company PMs, are they more likely to be successful at creating a company? I remember chatting with February Screen, the 47 episodes back, about an app called Slice, the pizza app. I remember Googling the founder. He was a pizza store owner and they raised Series C back then. It sounds like he didn't really come from a traditional tech founder background and still doing successfully. Curious, do you see any more founders coming from diverse background with unique expertise doing innovations in their domain? Or do you see the successful founders still mostly coming from traditional tech background?
Yeah, no, I think it's a very legitimate question, and one that we get asked often because VC is about pattern recognition in large part, right? And so what I would say is that when we look at founders, we do often ask ourselves this question of why is this the right team to get done what they are hoping to achieve? And when we say that, though, it's less about, or it could be all of these, right? Industry expertise, functional expertise. It's a visceral pain point that they feel every day. And so they're almost have an emotional attachment to say, if not for me, no one else is going to solve this. And like, God damn it, someone's got to solve it, right? And so what I would say is that it's not like we can check the box on which one applies for which founder or which opportunity, but we need to know that there's a compelling reason why this is the right team. And so to the example you talked about with Slice, I think, it was maybe they grew up in the industry, meaning their family owned a bunch of pizzerias and they saw that why couldn't, I think, part of the pitch is why couldn't a local pizza place be able to dominate the way that Domino's does? And so they saw firsthand what the opportunity was and probably built the product in a way that was fairly user-friendly for the pizza shop owners. And so I think that yes, in terms of a founding team, you want to have a good balance of people who are technical, probably at least one person that's more business oriented. But I think we're fairly open-minded in wanting to assess what about this founding team is going to be the reason why they actually succeed.
If I'm a startup founder, how do I strategically evaluate what's my expertise? If I'm passionate about multiple problems in different domains or have multiple solutions for a problem, how do I pick which ones to go after first to have a higher chance to succeed?
Yeah, I think part of it is also knowing that whatever you choose, chances are you're basically saying, I'm going to do this for the next 10 years of my life, right? I mean, that founder commitment is not to be taken lightly. I was just in a board meeting yesterday with a founder who dropped out of college to start his company. He's 12 years in, right? When we met him.
Oh, I thought he was 12 years old.
Oh, no. I'm sure there's other people like Thiel fellows who have backed 12-year-olds. But, when we met him, he was a college student. Since then, he's gotten married. He's a father to 2 children, right? It's like 12 years for someone who was maybe in their early 20s when we met them. That's a significant span of their lives. And I say that in some sense as a cautionary tale that when you're a founder, it's very hard to ever quit your startup, right? And hopefully if we backed you, you wouldn't, because we would have kind of rightly assessed that this is such a passion of yours that you wouldn't be able to easily walk away. And so I think that, yes, you should definitely think about it from the lens of what is my superpower, where I'm going to be differentiated in being able to make this company a success. But it's also important that you are going to be energized enough by the opportunity that being a founder is hard, right? And even the most successful companies, we joke, had not at least 9 near-death experiences. And what is going to allow you to have the resilience that you are going to still wake up every day excited for the opportunity to keep forging ahead. It's a high bar, I know.
Totally. In terms of the technical part of VC financing, is there any resources for first-time founders to pick up some entry-level terminology for venture financing so they could use it in their pitch?
Yeah, no, I think it's important for founders, especially if they're looking to fundraise, to educate themselves on term sheet basics, right? And yes, you'll probably engage counsel and they will paper it for you, but it's important that you understand the difference, for example, between pre-money versus post-money, and that will highly impact how much dilution you're taking, right? Why there should be an option pool and what the rates are of investors that are coming in. I worry that a lot of founders oftentimes don't weigh heavily enough how important the decision is of who they let onto their cap table, because you can't force someone off who's an investor in your company. I mean, it's kind of a crass joke, but it's much easier to divorce your spouse than it is to get rid of an investor. There is no kind of legal arrangement by which, and so you're stuck with them, but it can be tempting in the moment to say, I'm going to go with whoever gives me the highest valuation or the largest check size or who got to the finish line the fastest. But you have to understand that person is going to be with you and be a significant owner of your company until the very end. And so you want to go into that process being incredibly thoughtful about who's going to be the right partner for you in this journey.
I don't know how many startups have many options about choosing which investor they want for their startup. How do you navigate the fundraising journey when you don't have many choices?
Yeah, let's talk about a more extreme example. So if you find yourself with only one term sheet and it's someone with whom you don't see yourself being able to partner, there is the very real question of, should you just decline fundraising, find a way to bootstrap or raise money from friends and family, cut your burn, assuming it's, more than just you, and say, I'm going to do this my way for another 6 months and try to fundraise again, right? Because 6 months in a startup's life cycle is a complete generation. And so you can be in a very different position, because part of it is also dynamics that may not be necessarily just reflective of you or your company. Think about COVID, right? I mean, the fundraising environment in March or April was very different than it is now. Now it's much more welcoming. There's a lot of up rounds getting done. March and April, people were probably reticent to write a check, not knowing what the economic outlook was going to look like. And so that's always a possibility, is you decide, okay, I thought I could move faster by fundraising, but I'm going to have to make do without it and focus on capital efficiency, even though I'm just at the beginning of my journey. And then for others, I think, fundraising, yes, when you are a seed or early stage company, part of the benefit of taking a check from a VC is in some ways you get the leverage of their brand, right? They're signaling as you're trying to recruit, as you're trying to raise your next round of funding, to be able to say, I am a Floodgate company. That having been said, I think it's also important to recognize that who is actually going to be interacting with you day to day is the partner that's leading the investment. And so it may mean, in the same way that VC is taking a chance on you as a first-time founder, you are taking a chance on that VC who is, maybe lesser known or earlier in their journey. But there is plenty of examples, right, of first-time founders and first-time VCs that end up having incredible outcomes in terms of, IPOs. And so I think that everybody kind of has to go in with a mentality of wanting to find the right match for them, regardless of the halo effect that a brand name can bring with them.
Let's say, hypothetically, my startup got multiple term sheets. How do I identify the right VC for me? It is hard to get to know someone over a brief interaction, and I assume if I ask any of their portfolio company, they are only going to say good things about the firm. How do I find out if they have the right resources and we're going to work well together in the long run?
Yeah, absolutely. And, most VCs, as they're diligencing you, it's going to go anywhere like 3+ meetings, right? And so I think you will get a good sense from them as to where they're focused and where they're going to push you. And you're going to have to assess for yourself, like, okay, do I like the types of questions and how they ask their questions? Will this person actually encourage me to be a better CEO and founder and keep pushing more product? Or are they just going to be money that's on my cap table, but they'll stay out of the way, right? And you have to solve for what you're looking for. And then there's just the very kind of practical tactics of checking on your VC, which is you can always ask the VC for references, but then you should I encourage founders to explicitly ask for references where they had to shut down their company. Because if you are speaking to a founder who's had an incredible exit, there's always going to be a little bit of revisionist history, right? It's just human nature. Versus if you talk to a founder who had to shut down their company, it will give you a sense for the actual character of the VC. And, at least at Floodgate, our commitment to you is that we will be in the foxhole with you. And again, we are your co-conspirators. And so whether it's ringing the bell in the New York Stock Exchange for you, we'll be there to celebrate. And if it's you having to shut down your company, we'll help you navigate that as well.
That brings me to my next question. There is a statistic says that 95% startup fail. How many percent startup fail that is backed by good VC firms?
Yeah. I've heard that stat as well. And I don't think it's that extreme unless you're talking to, I think, what your point, which is a lot of those startups probably never raised venture funding, or they may be more what we think about as SMBs and not necessarily software powered startups. I think what's much more likely to be the case is I think there's another stat that says somewhere along the lines of only maybe half or 60% of VC-backed startups ever return the money that they raised. And so
that's really high. I'm sorry.
Right. So it may not be that they fail, as in they shut down, but for example, maybe they don't exit, right? Maybe the fundraising environment for them dried up. And so they had to become cash flow positive, and they're basically just kind of break even, but they're neither growing nor able to get more investment to actually flourish. And so I think that's probably more what's likely, or that they're a large enough exit that they can actually move the needle on a portfolio's returns.
Wow, that's way better than I thought. For the 40% startups, quote unquote, fail, where does the founder go? Do they apply a job at Google? Can they still raise money for the next company? Is there any pattern for the next steps for them?
Yeah, so you will see founders, especially if it's a smaller team, be able to basically get their team acqui-hired. And in those types of situations, at least more recently, there's usually not really return to the investors. It's just about a team that's already worked together that will interview as a group to be hired into one of the larger tech companies. And otherwise, the other situation that we see that's not uncommon is the company shuts down and everyone just kind of finds their own way. And you'll see founders, to your point, either then just get hired into a larger company. Oftentimes at that point, they're looking for more stability. So they're not necessarily going to go join a startup where they're not CEO, or they'll stop, take some time, and then launch their next company, right? There's some CEOs or founders who kind of just, it's in their blood. They can't not be an entrepreneur. And so after they take a little bit of a break and clear their minds, we'll come up with the next idea.
Speaking of success and failure, normally we only hear the successful stories. For the successful founders, did they have many failure projects before starting something successful?
I mean, to be honest, the successes are always the outliers anyways, right? And so the reason why I point that out is because then what I'm going to talk about is even more extreme, where it's the outliers for the outliers, right? And so a classic example there would be Stuart Butterfield, who just sold Slack to Salesforce for a very high premium. It's an incredible exit, and that's obviously after he had already taken Slack public. But Slack as a company started off as a gaming company. And it was really a communication tool that was internal. And that when they realized that the gaming company wasn't doing well, they decided to make a go of somehow then instead monetizing the communication tool. And so I think that, yes, there are founders who had multiple, maybe failed attempts at startups and then go on to launch something that's incredible. But I think that I'm more familiar with examples of founders who end up finding success after the company that they had already started sometimes just doesn't become big. It's not necessarily that it's a failure, and then they pivot, and then that company becomes huge. There's two other examples I think of. The Lyft founders, obviously, when we invested in them, were actually running a company called Zimride, which I think of as carpooling software for campuses and corporates. And it was a good business, but it wasn't going to be the scale of Lyft, right? But it was 2.5 years in after they had launched Zimride that they decided to start the ride-sharing economy, and it became something much bigger. And the other example is Justin.tv, right? And people love to think about like, oh God, these four friends, sold their company for $1 billion. They were grinding it out for several years. And when it was Justin.tv, they couldn't even get it funded. So they actually had to become profitable. And then the business that became Twitch had only been live for about a year before they sold it to Amazon for close to $1 billion. But that was maybe year 7 in their journey. And so people can look at Twitch and say, oh, it was an overnight success. It was only around for a year. But Twitch was the outcome of them having already grounded out with Justin.tv and Social Cam for the 6 years prior.
The other day when the speaker from YC gave us a talk at our class, I feel really shocked when he mentioned YC still think themselves as the underdog, even getting into YC these days as a founder, basically equivalent to getting into Harvard or Stanford or something. I feel like that mentality is really humble and respectable.
Yeah, it's funny because I agree with you. I think there's a lot of pedigree associated with YC, that it is credentializing. I know founders who had already started their companies that will then still go through YC because it gets you access to more investors, the cohort, right? There's a lot of benefit to going through YC. But I actually really appreciated that Michael said that, because it was that startup CEO mentality of you always stay hungry, right? You never let up. You continue to innovate. You're constantly out there feeling like you have to hustle, and you never rest on your laurels. And I think you see that in the best kind of founder CEOs, where even though the company has gone public, right, and the founder is still in the seat as now a public company CEO, that they're relentless, that they will never give up, and they're still grinding away as if it's the first year of the company, and they're afraid that they're not going to be able to raise their next round of funding.
Thank you so much, Harris. I'm really thankful for being a part of the Floodgate Building Breakthrough cohort. I would love to let my audience know more about the program.
Yeah, no, I appreciate it. I mean, we're super grateful for every student that took a chance on us. It's called Building Breakthroughs, and it's based on a class that we had been teaching at Stanford for quite some time. It was Anne who had spearheaded the Stanford class at the School of Engineering, and I think at that time we were calling it Intelligent Growth. But with all classes being remote, we had been thinking for a while about like, should we take this to other campuses? And so I decided to launch it as a completely remote class with a student of about 50 students. And it's really a chance for future founders to better understand the frameworks that we've developed and used at Floodgate to evaluate investment opportunities. The example I gave in the first class was, I'm sure it's incredibly frustrating that one of the most common reasons for a pass you'll hear is we just don't think it'll get big enough. And so we go through for the example of why the size of the potential outcome really matters, especially for a fund like Floodgate. So that we thought it was just important, especially because for a pilot class, it was very important to me that it be geared towards underrepresented founders, that they better understand the lingo of VC, right? Like, what is it that we're looking for in a pitch? What is it, more importantly, that we're looking for in the business that you're building? And why should that be important, not only to us as VCs, but to you as founders? And so my hope, again, to, kind of loop this back to the story I shared with you about how I grew up, is I understand what it means to not be given a fighting chance because you don't necessarily fit the profile of what other people are accustomed to. And so I'm a big believer in giving other people a chance by educating them on what the expectation is and seeing if they rise to the occasion.
Yeah, totally. Well, thank you so much, Aries. So we're at the 1 minute fire round session.
Oh my goodness, I didn't know this was a thing. I'll sit up in my chair.
So the first question is, what's your favorite book?
So I love this book called Quiet, and it's a friend of mine had actually,
Susan
yes,
Kane wrote it.
And she had introduced it to me because I think of myself as an introvert, but I learned social skills like anybody else does to survive. But my older son, especially when he was younger, was just very quiet. And as a parent, it's very uncomfortable when you're parenting a child who seems different than you. And in reading the book, just understanding the strength of people who are comfortable actually being quiet and being able to observe. And I always joke, like, especially when I was in banking, which is obviously a client service business, that I'm very uncomfortable with silence and feel the need to fill that gap. And so it was very enlightening for me to be able to understand, again, the strength of people and also what their needs are. I actually do feel like I may be someone who is an extreme introvert then, because I concentrate best in a vacuum by myself, no white noise. I just need to be able to focus and crank something out. And so I appreciate any opportunity to have my eyes open to new thoughts and new profiles.
Yeah, totally. Who made the biggest impact in your career?
So this is a tough one. And it would be a ton of fun if I was able to name some, Fortune 100 CEO or some Midasless VC. But to be frank, I think it's my mom, right? Again, for her to be, think about their generation of Korean women. A lot of families weren't exactly investing in their daughters to go to college, much less medical school. And then for her to leave Korea and all of her family to come to the US for residency, and then to give up being a doctor and a professor at the Children's Hospital of Pennsylvania to join the U.S. Army, there are kind of no boundaries to what she thought was possible. And that's something that I still strive for every day, that she has much more of this mentality. And she was a very involved mother to 3 children. Being a working mom is hard, right? I admit that humbly every day. But to be able to have someone who role modeled for me that there should be no constraints, that I have to choose one thing or another, or feel like I'm opting out because of the priorities that I placed, is something that's kind of incredible.
Who would you invite to your dinner party?
Oh, this is so much fun. So I think that, honestly, at this point, it's like anyone, because with quarantine, I would just love social interaction. But again, I think about it as I love the people that I've discovered in my life that have become my trusted advisors. And 2020 for me, it's funny because it's been a year of experiments. And maybe it is because we've been quarantining. And so I've got the benefit of having daily check-ins with my team, but I'm not actually physically in an office with them. So it's allowed me a little bit of the distance to say, I'm going to try things that don't feel comfortable for me and evolve as a person. So launching the Building Breakthroughs class was one aspect of that. My doing these market musings on Twitter is also something that's very new for me. I'm a very private person. I'm not really on social media. And I'm also okay with that. But I have a lot of friends who have been pushing me to try to grow my social media presence more, or just put myself out there more, right? You being one of them. And so I feel like, I would want to have a dinner party with all the people that are my cheerleaders in the background that push me to keep evolving myself and trying to become the best version of myself.
Yeah. Where can we find you when you're not at work?
Yeah. So if anyone needs to reach me, I can be easily found at Floodgate. And otherwise, it's, find me on Twitter if you want to reach out to me. I'm just at Donuts Did This. But otherwise, in my non-work persona, I'm mostly outdoors with my 2 boys running around.
Nice. Okay. Awesome. Amazing. Thank you so much, Aris, for coming on the show today.
Yeah, it's been a pleasure. I really enjoyed it. Thank you.
All right. That's all we have for today. Thank you so much for listening to this episode of Smart Venture Podcast. I want to say a big thank you to you, my listener. Smart Venture Podcast has been nominated by the Asian American Podcasters Association for the Golden Crayon Award. I could not do it without you. Thank you. If you like it, please leave us a quick review and hit subscribe so you don't miss any tips from the experts. If you want to receive our updates, please leave your email at smartventurepod.com. If you want to connect with me, all my socials are at Grace Gong GG. Besides LinkedIn, it's just Grace Gong. I'd love to connect with you and let me know your thought about the show. Now you can also listen to Smart Venture Podcast on YouTube. Go to smartventurepod.com, click the YouTube link on the top banner. Don't forget to hit subscribe and smash that like button. See you next time.